this government was given a mandate to restore stability to our economy and to begin a decade of national renewal.
Since Chancellor Rachel Reeves unveiled her first budget in late 2024, it's been defined by a bold strategy focused on significant tax increases for businesses in an effort to repair the UK's public finances. A central element of this plan was a rise in employer national insurance contributions, expected to generate around £25 billion per year, making it one of the largest single revenue-raising measures in the 2024 budget.
We will increase the rate of employers' national insurance by 1.2 percentage points to 15% from April 2025. And we will reduce the secondary threshold, the level at which employers start paying national insurance on each employee's salary, from £9,100 a year to £5,000. This will raise £25 billion per year by the end of the forecast period.
This increase, which came into full effect in April 2025, has raised payroll taxes for every employee, adding new costs for businesses across the country. Now, by mid-2025, a pressing question is being asked: has this budget sparked a jobs crisis? The reality is that the UK's labour market has undeniably weakened since the budget. Employment has declined and unemployment has ticked up. But is this a full-blown crisis or an economic cooling? In this report, we break down what's happened in the job market since Reeves' 2024 budget, using the latest available data as of July 2025 to assess whether Britain is truly facing a jobs crisis or simply adjusting to a new economic reality. First, the hard data. Are the number of jobs increasing or decreasing? They are decreasing. Official figures show that the number of people on UK company payrolls has fallen since the budget. In fact, in June 2025, there were about 178,000 fewer payrolled employees than a year earlier, a 0.6% drop. That marks a sharp reversal from the steady job growth Britain saw after the pandemic. Early estimates suggest payroll employment peaked around late 2024 and has been edging down since. To put it plainly, companies have been cutting staff, not adding. HMRC data from pay-as-you-earn records initially caused alarm in spring 2025 by indicating an enormous drop, over 109,000 jobs lost in a single month, May 2025. That would be the worst monthly fall since the height of the COVID lockdowns, fueling talk of a jobs crisis. However, the Stats Office later revised that figure way down to about 25,000 jobs lost in May. With those revisions, the cumulative job losses since the Reeves budget in October 2024 are estimated at roughly 185,000 roles. Still a large decline, but about 91,000 fewer losses than first feared. In other words, things are bad, just not quite as catastrophic as initial scare suggested. Here's a quick summary of key job metrics, latest as of July 2025. Let's take a look at where the UK job market stands as of July 2025. The number of payrolled workers came in at around 30.3 million in June, down roughly 185,000 compared to October 2024. That's the lowest level in nearly 2 years. Even more concerning, 41,000 jobs were lost in June alone, pointing to ongoing reductions in workforce numbers. Meanwhile, unemployment is on the rise. Between March and May, the jobless rate climbed to 4.7%, up from around 4.1 to 4.3% before the 2024 budget. That makes it the highest unemployment rate in almost 4 years, with more people actively job hunting now than at any point since mid-2021. When it comes to job openings, the situation isn't much better. In the 3 months from April to June, the UK recorded 727,000 vacancies, which is 56,000 fewer than the previous quarter. That marks the 9th consecutive quarter of falling vacancies, a clear sign that employers are scaling back recruitment. In fact, vacancies have been on a steady decline for the last 3 years, ever since their peak in 2022. Wages are still rising, but at a slower pace. In spring 2025, annual pay growth hovered around 5%, down from about 5.5% in late 2024. That means pay increases are getting smaller as the job market cools. The one bit of good news is that wage growth is now significantly outpacing inflation, which sits between 3 and 4%, so workers are finally seeing a modest rise in real pay. But the clearest warning sign might be redundancies. In June 2025 alone, the number of potential layoffs filed by employers was 68% higher than the same time last year. So while hiring is slowing, more businesses are also preparing to cut jobs. In short, jobs are decreasing, not increasing. Britain has roughly a couple 100,000 fewer people on payrolls now than it did before Rachel Reeves's budget. Unemployment is rising, now at levels last seen in 2021, and firms are posting fewer job ads. That's a marked shift from the red-hot labour market of 2022, when unemployment hit multi-decade lows of around 3.6% and vacancies hit record highs. So, by the numbers, the UK labour market in mid-2025 is weaker than it was pre-budget. Fewer people employed, more people jobless or redundant, and employers more cautious about hiring. Those facts have led some commentators to indeed use the phrase jobs crisis. For example, more than 250,000 jobs appear to vanish in the months after the budget, and Britain's unemployment climbed to its highest in almost 4 years. However, context matters. A 4.7% unemployment rate is not an out-of-control disaster by historical standards. It's a far cry from the double-digit unemployment of the 1980s or the peaks after the 2008 financial crash. In fact, coming off an all-time low of 3.5%, an unemployment rate under 5% is still moderate. Many economists would say the job market is cooling, not collapsing. That said, the trajectory is concerning. If the current trend of falling employment, rising redundancies and shrinking vacancies continues, the UK may very well tip from a cooling phase into a full-blown jobs crisis. That risk is real and growing. Ultimately, it will be up to Chancellor Rachel Reeves to take decisive action and prevent this trend from spiralling further. Stabilising the labour market and restoring business confidence will be one of her defining challenges, and the next few months may prove pivotal. Why are jobs falling now? A big factor, the budget itself raised the cost of employing people. In October 2024, Chancellor Reeves announced a package of tax hikes, the largest being a £25 billion increase in employer national insurance contributions. Critics of these tax hikes referred to the employer national insurance contributions as a jobs tax, which kicked in fully from April 2025, meaning businesses have to pay higher payroll taxes for each employee. Employers, unsurprisingly, were not supportive of the move, especially given that businesses are already facing the highest overall tax burden in decades, with corporation tax, national insurance and other levies at their most demanding levels since the 1980s. Business groups warned from the get-go that raising employer national insurance contributions was essentially a tax on jobs that would force them to cut staff or freeze hiring, and now they argue those warnings have proven true. On top of that, Reeves's budget also hiked the national living wage, the minimum wage, significantly and introduced or expanded worker rights regulations. Good news for workers on paper, but from an employer's perspective, these added costs to have a worker on the books can discourage hiring. In fact, the Federation of Small Businesses points out the government has been ramping up jobs taxes and adding new employment laws, moves which, combined with the talk of raising employer pension contributions, are not a recipe for job creation. Translation: businesses feel the government piled a lot on them at once. Higher national insurance contributions, wage floors, more regulation. So they're responding by scaling back and staffing to save money. Let's not forget the broader economic backdrop. By late 2024 and 2025, UK firms were already facing multiple headwinds. First, rising costs and inflation. Energy bills and other essential inputs soared throughout 2022 and 2023. And while inflation has cooled from those double-digit highs to around 3 to 4% today, the damage hasn't exactly disappeared. Costs remain stubbornly high. Many employers, especially in sectors like hospitality and leisure, say sky-high energy bills and steep business rates are still squeezing them hard. And when profit margins are under this much pressure, something usually has to give. Sadly, that something is often jobs. Then there's the impact of high interest rates. To tackle inflation, the Bank of England raised interest rates aggressively across 2022 and 2023. Rates peaked at around 5.25% in late 2024 and have only just started to edge down to roughly 4.25% by mid-2025. Those elevated borrowing costs have taken a toll, particularly in interest-sensitive sectors like construction and real estate. Builders say demand for new projects has weakened, while higher payroll expenses, including national insurance contributions, are biting hard. That's why many have paused hiring or stopped replacing staff who leave. A recent survey even revealed that UK construction firms were cutting jobs at the fastest pace in over 4 years. Just another sign that high rates are throttling new development and trimming wage bills. And finally, economic uncertainty is hanging over everything. The UK economy has been teetering between stagnation and recession. Growth has been either flat or negative in several quarters. Add to that a mix of global instability ranging from trade tensions to geopolitical flashpoints, and it's really no wonder business confidence has taken a knock. And when confidence drops, hiring slows. In fact, a December 2024 survey found that 54% of UK businesses plan to respond to the new budget's higher costs by cutting jobs. That's more than half of employers saying point blank, we're reducing headcount because of these tax changes. So the big picture cause of the job market downturn is employers facing higher costs from all sides, especially direct government-imposed costs like employer national insurance contributions, at a time when the economy isn't booming. Hiring new staff or even keeping all existing staff becomes a luxury some firms feel they can't afford. As Neil Carberry, head of the Recruitment and Employment Confederation, put it, after a tough budget for employers, companies took time to reassess their hiring needs, and many decided to hit pause or even reverse on recruitment. To illustrate the point, the KPMG REC Jobs Index, which measures demand for staff, plunged to 43.9 in November 2024, immediately after the budget, one of its lowest readings ever outside of a crisis. For context, any number below 50 means falling job demand. Only events like COVID or the 2008 crash saw worse hiring sentiment. The REC said it should be a surprise to no one that businesses have slammed the brakes on hiring, given how tough the budget was on them. That early warning sign has translated into today's weaker job numbers.